All right. Hello and welcome everyone to Trading Coach's Corner. This is Brandon Wendell with you, or Trading Coach's Playbook. Sorry. Used to be Trading Coach's Corner, now it's Trading Coach's Playbook. Anyway, I'm still Brandon Wendell. At least that hasn't changed. And I want to welcome everybody. Before we do get started, just need to let you know that we are looking at possibly looking at the markets today. And if we do look at charts of the markets, whatever, we're doing it from an educational standpoint. So I'm not telling you to buy, sell, or hold anything or give any personalized recommendations about the markets. All markets do involve the risk of loss. That is always the situation. No matter what we do, we can never eliminate that risk. We just try to minimize and manage it. And we're also not subject to trading restrictions. So we can have positions in a security or initiate one at any time. And I don't know what I can do about the mic. I got it up as much as I can. So I don't know if it's just you, Brenda, or if everybody's having a problem with me with the mic volume. But this is my normal mic, and it was working yesterday just fine. So I don't know. Anyway, we'll go ahead and real quick let you know that there are plenty of workshops that we do on a regular basis. And you can catch us in some of the free online workshops. Rob every Monday does Power Hour. We have the Trading Coaches Playbook every Friday. I just did a session called the Spread Spectrum last night, and I have a couple more coming up next week. And the E-mini Think Tank is where you can find me most of the time on Monday, Wednesdays, and Thursdays from 9 a.m. to 11. That's where I actually teach a lot of the information and trading pieces that I'm going to be covering a bit today. As a matter of fact, I logged in just a little while ago into the E-mini Think Tank, and you can see that I've got bonus material. It's kind of an on-demand, learn as you go education, and I'm actually re-recording all of the videos. So if you go into these bonus videos, you'll see there's a bunch of education there. And oh, thank you, Kevin. Kevin says E-mini Think Tank. It's awesome. Yeah, I have a lot of education here, and oh, your furnace was loud. Oh, you gotta stay warm. I know it's actually gotten warmer here today. I think it's like 35 degrees. So I'm just outside of Washington, D.C. Anyway, but I got lots of education, like I said, on here. There's stuff on trends, and I'm re-recording all the videos and updating them this year. And I'm in the process of getting ready to release those with different categories and stuff like that. There's also documentation that backs up all that. So fundamentals, for instance, and there's even, what is here and how to get started on all this. So I'm reorganizing this as well to make it a little bit easier for you to understand. But if you want more in-depth education versus what I'm going to cover just today, then this is where you'd find it. And basically, let me go ahead and close that. And oops, I'm going to bring up this chart instead. There we go. And all right, there we go. Anyway, so today our topic is going to be on trends. So let me go back one more thing. I just like making aware of, again, the E-mini Think Tank is my main program where I'm pretty much involved teaching trading in the futures markets. And if you're looking at different ways of trading in futures, I actually cover, well, first of all, if you've never traded futures before, I have the Futures Boot Camp where you can learn about that. You can always email us at support@wealthbuildershq.com if you need, or if you have questions. I'll just put in the support at. There it is in the chat for you for the email address. If you have questions about any of the programs, E-mini Think Tank is futures trading, directional trading, both intraday and longer term swing trading, where we cover everything. Then Wealth with Spreads is a little more advanced as far as the technique. What do we do there? Again, there's that program that I'm talking about for the uh, spread spectrum coming up next week, where I talk about how we trade spreads in futures. So it has nothing to do with options. If you want options, I actually do have that covered in what's called the SPX Cash Flow Secrets. And there's a program where I trade options on a daily basis to generate income. Anyway, today, like I said, we're going to kind of talk about trends. And the reason why is that trends are important because basically the markets move in two different environments. Let me drop down to say a 60-minute chart. And this is kind of a good example of it right here. We have two environments for the markets. Okay. We have impulses and we have corrections. So the impulses, those are the moves in the same direction as the trend. Okay, corrections are the pauses or pullbacks against the trend. And basically, if you want to profit in the markets, well, what did I do there? There it goes. I was gonna say, I thought I typed it in. So if you want to profit, you're probably going to want to profit by trading the impulses. Oh, did I do 24? Oh, yeah, you're right. I did 24. Doesn't matter for this example. Thank you. It should be 25. See, I've been writing checks with 24 as well. No, I'm kidding. I don't write checks. Who does? Anyway, but the impulses are the smaller moves in the same direction as the dominant trend. Meanwhile, the corrections are the pauses or pullbacks that go against the trend. So typically, when we trade, we want to trade with the trend. And that's because these are the largest. And when I say largest, I mean price wise, they cover the most distance and most severe. So basically, they move fast. And it's your opportunity to profit. Meanwhile, the corrections usually they take more time. They're shallow in price, so they don't move nearly as high or as steep. And therefore, this gives you the opportunity to re-enter at a better price. So we typically want to trade in the direction of whatever the dominant trend happens to be when we have a correction. That gives us our chance to get back in. So looking at this, you can see that I'm on a 60-minute chart. If I were to go to a 4-hour chart, a bigger time frame, that would be my trend time frame perhaps. Basically, what we would see right here at the end is a downtrend. And keep the definitions of trends pretty simple. We don't want to overcomplicate things because it's very easy to overcomplicate in the markets. The definition of a downtrend, actually, let's start with uptrend first. An uptrend is nothing more than higher lows followed by higher highs. As long as you have those higher lows, you are in an uptrend, period. Okay. If you fail to make higher lows, you make a lower low, then pretty much you've broken the trend. But that's all an uptrend is. It's a bunch of higher lows followed by higher highs. A downtrend, however, is nothing more than lower highs followed by lower lows. So as you can see right here, overall price is moving down, and we have high, low, lower high, lower low, lower high, lower low. We're in a downtrend. Okay. So if we're in a downtrend, we should be focusing on shorting opportunities or selling opportunities because that's going to give us the better overall price movement. You can see in the move down here, 1, 2 red candles, 1, 2, 3, 4, 5 on the pullback. Those 2 candles covered a lot more price movement. I'll thicken this up a little bit. Again, this is my impulse down. Then, see visual order, bring to front. There we go. This is the correction, which, as you can see, took more time and covered less distance. Then we have another impulse. Again, covering a big move, actually kind of pause right there. Then we have another correction. Wow, it lined almost exactly. There we go. And you can see that this impulse was only 1 candle. This one was only 1 candle. Meanwhile, we had 5 candles in the correction. So typically, you're going to want to trade in the dominant trend direction because you'll make more money and you'll make it faster. I mean, that's the whole goal, is to profit from the markets. We want to put the odds in our favor. And the odds are in our favor if we trade with the dominant trend. Now, you can trade counter trend if you choose to. The problem with that is if you trade opposite of the dominant trend, you have more risk. But the thing is, markets always reward you when you take greater risk. If you reduce risk, you reduce reward. You can't have one without the other. They're always tied together. So they're like attached by a string or a chain. Okay, it's very hard to break that. It's almost impossible to take less risk without taking less reward. Take into account if you were to trade micros versus full-size contracts, right? If you were to go out to, let's go to barchart.com as an example. And in futures, we'll go to contract specifications here. And I'll go to indices since I'm talking about those. And we can see we got the NASDAQ E-mini, and the margin is $25,144. If you want to trade the NASDAQ micro, it's $2,500 for the margin. And your point value is gone from $20 per point to $2. So you make less, but you risk less. And therefore you have less, less loss if you're wrong. But you have less reward if you're right. So if something as simple as changing the size of the contract from a larger, size contract, I mean, that's not even the biggest one. We have a full size E-mini S&P 500 that is $250 per point. This one is the E-mini, which is $50 per point and $16,000 for margin. And then we have the micro, which is $5 per point and $1,600 for margin. So again, you can adjust your risk and lower it by trading a smaller contract. You also lower your reward. Same thing in Forex, same thing in stocks. If you buy 1 share versus 10 shares or 100 shares or 1,000 shares, your risk changes. So it's all about probabilities and adjusting risk. If we trade with the dominant trend, whether it be up or down, we trade with the impulses moving in that direction, we have a higher probability of profiting and making more. And we actually are increasing our rewards if we do take counter trend trades by trading the corrections. Again, I'll go back to the 60-minute now, and you can see what the corrections look like. They're those smaller moves going opposite the dominant trend. That's it. There's the impulse. It's adjusted a little bit weird. There. And there. And you can see if I was shorting because we're in a downtrend, I'd be making a lot more money than if I'm trading counter to the trend. Now, would I make extra money by counter trend trading? Yes, but I have extra risk because if this turns around, it goes against you very, very fast. Now, when it comes to trends, we also have to make sure that we are working on a trend that is going to be influencing us. And what I mean by that is I do multiple time frame analysis. I'll stay on this page for my notes for now. And what I mean by that is I actually learned this many, many years ago. I followed Dr. Alexander Elder, and he wrote a book called Trading for a Living. Not necessarily saying you have to go out and buy the book or read the book, but it was decent. I definitely do not follow a lot of what he put in the book, but one of the things I do follow is multiple time frame analysis. And because we don't live in a vacuum, we got to pull our heads out of the sand, so to speak, and make sure that we're identifying all the possibilities and things that will influence our price action on whatever security we're trading. And by the way, this works the same on futures as it does on Forex, as it does on stocks, as it does on options trading. Okay. So any kind of and crypto, I mean, you can do the same thing. Charts are charts. If you take away the price and the time that you're seeing on the top and on the bottom axis, you can do the analysis on any chart the exact same way. Because we're not actually charting those securities. We're charting people and people's perceptions and people's actions on those securities. That's really what we're charting, people. So anyway, with Dr. Elder, he actually kind of, he didn't come up with this. He kind of refined it, I guess. And It was actually, I know Charles Dow, Dow Jones Industrial Average, back in the late 1800s, early 1900s, he also talked about multiple time frames and how the markets moved in waves, and there are, kind of like tides going in and out, and there's waves on the tides, and there's little wind ripples on top of those. So there's multiple things happening all at once, but they're influenced by something larger. So to me, time frames are related by a factor of 5. Okay. So, and this is kind of what Dr. Elder talked about in his book. And doing your analysis, I actually will look for entries and exits on a small time frame. Now, small is relative. To some people, small is 1 minute. Some people, small is daily. Okay. Small time frame means the smallest time frame you're going to be referencing in your charts. I call that my zone time frame. Okay. And that zone time frame, actually, let's do this. There we go. Whoa, what happened there? So my zone time frame is my lowest time frame, and it's where I identify supply and demand. And if you don't understand all of these things I'm talking about with the time frames and whatnot, again, if you go into the E-mini think tank under documents for fundamentals as well as the videos, I have zoning techniques. Where's here? Yeah, base leg zoning technique, how I find the zones, and even how to identify trends. I have videos on all that, targeting, how to know where to get in and out, trading routine and finding zones. So there's self-paced education that can help you with that. And I was trying to find there's trend. There it is, trends. I knew there was something on trends. Times 5 means that they're related by a factor of 5. Sorry, I should just say factor of 5. There we go. So if you're not sure what supply and demand is, again, this is a different way that I look at the markets. I don't use support and resistance. I use something called supply and demand, which to me works much, much better. It's a little bit stronger and better to identify things. So the zone time frame, that's where I'm going to find my entries and exits. I'll explain what the factor of 5 means in just a little bit. Okay. You'll see. It'll make sense. So I identify where I'm going to enter and exit on this lower time frame, the zone time frame. But here's the thing, if I find a demand zone, for instance, a demand zone on one time frame, which of course I don't have any right here visible. Okay, maybe now. Oops. Move this up. There we go. Nope, that's not even really great. Let's say that we've got one here, possibly. And maybe even above that right here. Now, when I identify an area of demand, this is an imbalance where there's a lot of buying pressure and very little selling pressure. However, what am I supposed to do at demand? I could do one of two actions. At demand, I could enter a long or exit a short, right? I could do either one of those. I could either go long or I could exit a short. How do I know which? What am I supposed to do? Same thing with the level of supply. For instance, this was a supply zone here. It's already been used, but it was supply and it worked. Well, at supply, I could enter a short or exit a long. And again, what is going to tell me what I'm supposed to be doing? Am I supposed to be going short? Am I supposed to be going long? What am I supposed to be doing? The trend tells me. It tells us the best direction of trading. Will we be likely to make money to the upside or to the downside? That's what the trend does for us. It tells us which direction we're supposed to be trading. Should we be entering or should we be exiting? Period. Now, how to choose the right one? Well, going back right here, back all my notes. There we are. Basically, I need to identify my next zone or my next time frame. So I have my zone time frame, but then I also have use that one. Oops. Let's go. Yeah, it's probably good. Trend time frame. And this is where I find or identify the trend and the best. Hang on a second. Phone keeps vibrating. Sorry, I want to turn it off. There we go. The best direction to trade. Okay. Now, there's a relationship between those two. There's also, trends don't go on forever. They eventually end. So I have another time frame that's going to be higher. And let's see, we'll do that color. I'll call that my perspective time frame. Okay. And in the perspective time frame, that's where the trends are going to end. Because trends don't go on forever. They eventually reverse, they pause, right? Demand could equal buying, supply could equal selling. Yes, it's imbalances basically. Okay, so these three time frames are related to each other by a factor of 5. So what does that mean? Well, it basically means that, for instance, if I'm looking at a zone time frame, I choose that zone time frame that I want to trade on. Right? That's the first thing I do is I choose, okay, what time frame do I feel comfortable trading on? That's what I'm going to use. Okay, and this is chosen on risk tolerance. Yeah, you choose how much risk you're willing to take. Bear with me 1 second. Okay. Sorry, I just had to go check on my chickens real quick. I hear them outside, and every now and then it's because there's a hawk trying to get to them or a fox. But they're okay. They're safe. Anyway, so my zone time frame is chosen based on the risk tolerance. No bears. Just we have foxes and hawks around here, but they're all fenced in. They're protected. I got electrics stuff around it. Anyway, you want to choose whatever time frame you feel comfortable trading on based on the amount of risk you're willing to take. You can choose the size of the contracts you want to trade or the time frames. Higher time frames will have bigger zones and more risk. Smaller zones are on smaller time frames. Once you figured out that zone time frame, then we have to choose this trend time frame. And again, the trend time frame is actually going to be related to the zone time frame. The trend time frame is equal to the zone time frame multiplied by either 4, 5, or 6. That's what I mean, a factor of 5. So the preferred number would be a related factor of 5. However, we want to stick with common time frames. So let's see if I do this zone time frame, trend time frame, perspective time frame. They're all related, like I said. Come on. Let's go with this. No, never mind. Okay, so we have our zone time frame, trend time frame, perspective time frame. So as an example, if we decided we were going to trade on a 1 minute time frame, my trend time frame that I might use is 5 minutes, right? Times five. Now, do I need to use times five for my perspective? Not necessarily. I could use times six and use a common time frame of 30 minutes. It's a personal preference. So right here, the perspective time frame is again equal to a multiple, but we're going to multiply the trend time frame by 4, 5, or 6. And that's how you arrive at those. That way we are seeing something related. If you're trading a stock, you don't want to jump from a 5-minute chart to a daily chart because there are other trends that are going to be influencing how you are trading and what you're trading. Okay. So for instance, if I want to change this, let's say we're doing a 5-minute chart, but actually I won't even go there yet. We'll just do 3-minute. Okay. So from a 3-minute chart, maybe we use a 15-minute chart for our trend. And then we could use perhaps a 60-minute chart times 4 for the perspective time frame. 5-minute, and this is not all inclusive, maybe 30-minute times 6, and then 180-minute. You could also use 150-minute if you wanted to by 5. Oops. But that's it. We want to make sure we have a related time frame that's going to affect us, and not something that's not going to be influencing us at all. Maybe if we do 10-minute or 15-minute, we could do 60-minute and 240-minute. If you do 30-minute, maybe you're doing 180-minute. And then let's see, that's 3 hours. Depends on what you want there. You could do daily to be times 6 is 18. It's kind of close. Or you could do something in between. If you did 60-minute times 4, that'd be 240-minute. And then daily, the 6 times 4 is 24. Or if you're doing daily, actually I skipped 240-minute, daily, weekly, daily, weekly, monthly, and so on. Okay, it's just an idea of the different time frames we could possibly use. And here's part of the reason why. Let me bring up paint for this. And I kind of equate it to a train. So for instance, here we have a train track that's running up the eastern seaboard of the United States. And we have the end of the line up here. We have the bottom of the line, the other end down here. Okay. And perhaps along the way, there should be some stops. And it could be more. I'm just going to use that for now. So the stops are the zones. Okay, well, first of all, the ends of the track, the top end of the track, maybe that's Boston, right? That's where the train is going to end, and it can't go any further because there aren't any tracks there. Miami might be at the other end of the track. We can't go beyond because there's nowhere to go into the ocean. That's it. Along the way, though, there's going to be stops, and those are the supply and demand zones I was talking about. So maybe we've got New York, Philadelphia, soon to be NFC champion Eagles. We've got DC, that's where I am now. Maybe Charlotte and Atlanta. So those are the stations where the trains can stop. Yeah, same rules for ETFs. It would be. Yeah. So those are the stations where we could possibly get on or get off. Those are the zones, basically. So if I look at this, this represents the end of the trend. Oh, why did that not go? Oh, because that's why. This is the lower end of the trend. As I said before, the blue, these are all the on the zone time frame where we can get on and off the train. The train direction is the trend. And we can either be traveling in a northbound train, or perhaps we are traveling in a southbound train. Okay, that is our trend. On the trend time frame. So if we get on board, for instance, the trend that we have here, that seems to be in a downward trend. Again, I went to the 4-hour time frame. And you know what? I'm going to go to a different chart now, clean this up. So I'll go, let's say QQQ, just to show it's on ETFs as well. Okay. And I'll go to the 4-hour time frame because maybe I want to make a swing trade on a 1-hour. Right now, if I ask what trend are we in, first of all, to get a proper perspective of trend, we need to make sure we're looking at enough candles. If you look too close, this looks like a very sharp uptrend right now. Okay, we do have low, higher low, higher low, higher low, higher low, and most importantly, afterwards, higher highs. We keep moving up. But are we truly in an uptrend? Well, let's take a look back. To get a proper perspective of trend, you don't need to count it, but you should be looking at roughly 200 candles. Okay, so to properly gauge trend, you don't have to count them. Okay, you could do a little less, a little bit more, but you want to get an overall view of what's going on in the trend. Another thing you can do to help you out with identifying the trend, sometimes it helps line charts. We don't want to look at every single turning point. Okay, I just want to look at the overall shape. Here, you can see a lot of little jagged moves all over the place. And the trends, yeah, they change. I mean, you've got this was lower highs and lower lows right here. Oops. Now we've got a higher high, so we can't be in a downtrend anymore, can we? We were in a downtrend right here. High, low, lower high, lower low, lower high, lower low, higher high. So basically, as soon as we broke out of this prior high, we broke the downtrend. Are we in an uptrend? By definition, no, we are not right now. In order to be in the uptrend, we'd have to have higher lows and higher highs. And trends do change. You can see, oops, didn't want that. That's okay. Higher low, high, higher high. Now we're in an uptrend right there. Before that, well, we were in an uptrend previously here. And I'll move both. Come on. There we go. You can see we're making higher lows and higher highs all the way up. How do I know when the trend ends? Simple. Oops. You can't be in an uptrend if you make a lower low. So right there, when you break down to lower lows, trend's over, right? As a matter of fact, we have confirmed a change in the trend because we actually have made lower highs and lower lows. And of course, the trend shifted yet again. There's another lower high, lower low. And there we change trends. Now, the problem with using it this way is that you don't know that the trend has changed until you've moved way off of a low or way off of a high. So as I said before, these major turning points in trend, often you'll find them better by looking for the prospective time frame and the reversal points. So right here, this was a reversal point where the bearish trend became bullish, right? And another one was here where the bullish trend reversed and became bearish. And up here, we had another small reversal, uptrend became bearish. And now, again, bearish trend became bullish. Why? Well, because the perspective time frame. Remember, if I'm trading on, oops, wrong button. Using, in this case, zone time frame, for my example, is 60-minute. Trend time frame is 240-minute. That means that my perspective time frame should be daily minute. Just kidding, just daily. So we're likely to see that these turning points are often going to be coming at daily turning areas at supply and demand. So I go to a daily chart and let's check this. As we're moving to the upside, okay, we don't actually have an overhead supply because this is an all-time high, right? But what we do have are other tools that can project, and I'm not going to get too much into depth on how to use those right now, but there are tools that we can use like these Fibonacci projections to give us an idea as to where the prices might be changing direction. And what do you know? Impulse, correction, projection for the next impulse, 61.8% projection from the perspective time frame, the daily. And that's where we had a reversal. Now that we're pulling back, we start a downtrend here, lower highs, lower lows. Where should this downtrend end? It should end at a demand zone from this daily time frame. Let's see what happens. Yeah, a little bit of possible demand here as well. There we go. And then the one I drew at the bottom. And look at this. Oh, we went down a little more. Actually down to this demand. It looks better on the futures, honestly, than it does on the Qs, but that's okay. I use the Qs. But we did actually pause here, didn't we? At demand, the first demand that I drew. Pause there, went down to the next area of imbalance, and that's where the trend reversed. As we're going back up, we make a high right here. Are we changing trends again? Well, remember, we have a low, high. If we make a higher low and higher high, we're in an uptrend. And there's a higher low. There's our higher high, so we're in an uptrend. If we're going to change our uptrend, again, we may end up turning at either a projection level or at supply. Not really great supply here, but that's something. You can see right here what's happening. We're putting in a peak at a Fibonacci extension. And we stalled out at the supply. It's working. So the trend's in trouble there, isn't it? It finally resumed itself after a little pause. Once again, I could use more projections and all that good stuff to figure out where is this trend going to terminate and possibly reverse. But that's how I can identify some turning points in the markets. I was saying the futures might be better. Okay, so again, NQH 2025. This is 2025 now. And the same thing applies. Lower highs, lower lows. Now we got a higher high. We broke the downtrend. Why do we break the downtrend there? Because the higher time frame demand, well, we weren't really at demand here. We were actually a little bit above the strong demand. We were at this, it's kind of a start of a move up. And not talking about that today. That was something from last night. Okay. But anyway, this is one of the things I do is I'm going to be using those bigger time frames to figure out where the trend's likely to end. Okay, this is the upper end of the trend. And as I said, it's basically, in this case, supply from the perspective time frame. Okay, that's what that is. I'm finding that supply from the perspective time frame to let me know where the upper area is. Or here we have demand from the perspective time frame to let me know where the downtrend's likely to end. My job is to get on board on these stations. And basically, it's talking about impulse versus correction. If I go back again to NQH24, where my notes were, go back to the 60-minute time frame. There we have impulse, correction, impulse, correction, impulse. Again, I'm not going to go into depth on this right now, but inside my lessons, there are lessons on Fibonacci, right there, mini Fibonacci. And basically what happens is we have some additional tools that we can use. The impulses, as I said before, they're going to be the moves in the same direction as the dominant trend. To measure the impulses, okay, we use fib projections or extensions, depending on what you want to call them, to measure impulses. Now, where's the next impulse going to terminate? How long is it going to go for? Where's it going to turn? Okay, we can actually use a fib extension or projection to figure that out. And that's this tool that I was using right here, where I was identifying an impulse, correction, and look at that, the new impulse terminated right at a 100% duplication of the previous one. Okay, it's not always perfect like that, but often it works out pretty close. Another impulse down, another correction back, and look at where we're bouncing right now. Again, the 100% projection. So it gives us an idea of where our targets might be if we're trading in the dominant trend. For the corrections, come on. Use Fibonacci retracements and correlate it with the zones, supply and demand. So we have the other tool here, which I'm actually using to draw zones. But right here, if we have this impulse down, we had a correction back. And notice impulse down, corrected up. And where did that correction terminate? 61.8% retracement of the preceding impulse. We had another impulse. Well, on our next impulse down, look what happened. Impulse down, corrected back up, 50% retracement, and impulsed again. So we can use some of these tools because right here, let's say we're in a northbound trade, we're in an uptrend. You might not be able to catch it in Miami. Okay, it'd be great if we did. If we could buy in Miami as we're moving in an uptrend, we're going to make the most amount of money because we got in early. Least amount of risk, most amount of money. That doesn't always happen. A lot of times we see it maybe in Charlotte because the trend is already developed and it's already moving. Well, if that's the case, if it's already in Charlotte or leaving Charlotte, maybe it went a little bit above Charlotte. We're somewhere between Charlotte and DC. I wait for a correction back to Charlotte for me to enter into the position, into the market. Let's see here. We'll do this. So we already left Miami. Again, this is like price moving. And we moved up already. All I have to wait for now is a retracement to the zone and maybe a fib retracement that correlates with it. And what do? I'm going to buy when prices get to Charlotte on the pullback right here. That's my entry spot. Does that make sense? And then what am I going to do? I'm going to trade this. And my first target might be DC. I might book a little bit of profits here because what's likely to happen at DC? Maybe a little pullback and another opportunity to get in. Ultimately, though, this train should make it all the way to Boston. That would be my second target. So basically what I'm looking at now is this. I might buy the pullback, as I said. There we go. Take profits at my next zone that we run into. Yeah. But eventually I'm going to try to hold on until we reach the end of the trend, all the way up there. That's how I trade. So if I'm looking at any security, okay, you can do a top-down approach, bottom-up approach. You can search for different types of strategies and things you were looking at in the markets. Whatever you want to do, it's entirely up to you. There's so many different ways of doing analysis. We'll cover that another time. But basically, if I'm just looking at a random security, let's say I want to look at corn, okay? So here I am on corn. Let's say I want to do an intraday trade on a 15-minute chart. I can start off on a 15-minute time frame and look to see where my zones are. Okay. So I'll start there and I look left and up and I notice an area of supply right here, possibly. And let's see, we've got another zone right above it as well. Can mark. This may not be the best opportunity because I'm going to start off looking at current price and down. And that's not really a great demand zone. And the reason why is I think it was demand back here. It was. So that was a test opportunity already. And maybe we have another one back here. The problem with doing this approach is, okay, I've got supply, I've got demand. I don't know if I'm buying or selling yet. How do I know? I go from the 15-minute, again, 15-minute zone time frame, 60-minute trend time frame. All right, that'll tell me which direction to trade. And 240-minute is my perspective time frame, telling me where the trends will end. So let's look. Go to 1 hour. And what's my trend? Well, I started counting highs and lows. Let's happen to it. Low, high, low. So we have a higher low right there. We don't have a higher high. Do we? We did back here, but not currently. Well, keep going back and count the highs and lows. This doesn't look like we're in any trend, does it? Wrong one. So we had low, higher low, high, lower high, higher high. That's an uptrend. Lower low, that broke the uptrend. Higher high, we're not in a downtrend. We're sideways. We don't have a trend. So we could buy the lows and sell the highs right now, or look for a different security. And I have certain strategies and things that I use in scanners to try to find good opportunities. But let's say we're just going to look for something else. Let me go to HOH 2025 heating oil. And I start off here and I see that we've got an overall downtrend, but it looks like it's pausing a bit right now. Not sure if this will be a good opportunity either. Again, looking at the trend, I just look for highs and lows. Again, if I have some issues, I can look at the line chart, look at the overall shape. But with the candles, at least, I've got obviously a high, lower high. That's a higher high. But we're not in an uptrend still. We have a low. We don't really have a higher low followed by higher high. If that's the current low we just made, higher low, we didn't make the higher high yet. So we're still in a downtrend. Well, we're in a sideways trend, right? So going down to the 15-minute chart, I could trade sideways trends by selling supply and buying demand. There's supply. Here's demand. Right here. Now, this is not a great trade idea. I'm just giving it out an example. We're in sideways movement. So sideways trends we can trade sideways. So uptrends, okay, we go long, right? You basically buy at demand, exit at supply. In downtrends, go short. There, we sell at supply, exit at demand. The sideways trends, either don't trade or buy low and sell high in the channel. Yes, trade the channel until it breaks into a trend. It could stay in the trend for a little while, or it could end up breaking out and you end up losing. But once you lose, then you've identified the trend that you're likely to be in. So you got that opportunity. So we could sell high, buy low. Now, if you're only a trend trader, then you would just look for something else, something that's in a strong trend. One of the things that I've done is, oh, I do have my toss open. Great. It's not in live, is it? No, I'm in sim trading. So let me log out of this real quick and log back in live mode. Or I could do it on TradeStation or whatever. It doesn't really matter what platform I want to do it on, but I have scanners that I created to help me find trend trading opportunities. And I share those with my students in the mini think tank, as I was saying. Right here under e-mini think tank, I have 889 trading strategies, a whole video on it. In addition to the video, there are documents on it. Where is it here? Other strategy. There it is, 889 trading strategy. And inside the trading strategy, I even include the scans that I use as well. So where is it here? Do live trading. And here's my password. So everybody write that down. Anyway. So as it loads up, I use what's called the 889 strategy that I created, and it allows me to find trending securities in almost any time frame. So again, if I'm looking at a 60-minute time frame, if I have a list of securities I want to trade, I can actually just bring it up, create a list. Now, the list I'm working with over here is different, so I'm not going to use that right now. There we go. Brought up the TOS live account here, and I can do, there we go, let's do full Forex. Let's say I'm looking for a 60-minute Forex trade. I'll change my chart, 60-minute, 4-hour, and go through the list and see these are trending securities, aren't they? It may not fit my criteria for this specific strategy, but for instance, Aussie Swiss or Aussie Loonie, those are very bullish right now, right? So if that's a bullish trend, again, this is on the 1-hour time frame. Let me do that. AUD CHF Forex. And like I said, it works on anything. Doesn't matter what security. Here I am on the 1-hour time frame. We clear the chart. There we go. And remember, my scan, this was a 1-hour bullish scan, Aussie Swiss, saying we're in a bullish trend. Well, I'm going to trade on the 1-hour bullish trend, but I can enter on a 15-minute zone on a pullback. First of all, are we in a bullish trend? Well, what do you think? High, low, lower high, lower low, lower high, lower low. Yeah, I would say we're in an uptrend, aren't we? Again, looking back at roughly 200 candles, we had a small snap in the trend here where we made a lower low, but since then, we've been experiencing higher lows. Gotta be careful you don't get caught up in all this little stuff, although that does work too in this case. but sometimes that'll throw you off on the trend. To me, that's all just one move, really. And then again, we've got higher lows here. And we're actually consolidating in a symmetrical triangle right now at the end of this possible trend. And one of the things I would do is check to see, okay, we're in a 1 hour bullish trend. Where's the 4 hour supply that's likely to end the trend? Are we there yet? Not really. We're close. Oh, maybe we are actually. Look at that. So we might be at Boston right now. We came off of Miami. As a matter of fact, take a look at this. Here's the 1 hour demand, 1 hour trend, right? That bullish trend kind of began right here because remember, we had that lower low right there. Overall, we were kind of choppy and really started rallying up. As a matter of fact, there's a downtrend here, isn't there? Right there. Here's a downtrend. This is where the downtrend ended, right here. And then we have higher low, lower low, but eventually became the uptrend out of this area. If we go from the 1 hour to the 4 hour time frame, why did we terminate the downtrend here? Remember what I said? There's Miami. There's demand on the 4 hour time frame that ends the 1 hour downtrend and begins the uptrend. So now we're coming up into Boston. We just went from Miami to Boston, and there were trading opportunities all along the way. So guess what? We're probably going to get a trend reversal soon because we're near Boston. It's very elevated risk because to go long, that is, because we're nearing Boston, which is why you're seeing this consolidation going on here as well. We're losing momentum. Doesn't mean automatically go short until we hit Boston, but there's a high probability this might be changing direction soon. And if we go down the 15-minute time frame, you'll notice, yeah, there's demand zones to be able to buy if we pull back. Even up here, as we were consolidating, there were a little drop-based rally. That would have been a nice little buy opportunity, but you see it didn't pay off too much because we went and started correcting as we got close to Boston. If we had gotten in sooner down here, perhaps, nope, not that one, sorry. Right here, there's another demand. This was New York. There we pulled back into New York, and that was our buy opportunity to make some money. And the reason why was at this point, right here, you look at the trend at that time, and we're in an uptrend, right? Higher lows, higher highs, we're in an uptrend. You look at the 4 hour time frame, and where's that dot? There it is. That dot, as we're looking at the 4 hour, you can see there's no overhead supply until here on the 4 hour. So that's Boston. We were actually in New York and still had room to go, maybe even Philly. And what happened? Made some money as it went to the upside. That's how you're supposed to trade according to the trend. So I've got to get going. Unfortunately, I gave you a little bit of an idea, so a little bit of how the trend works. If you want more education, more information, I showed you where to find it. We got tons of that information here in the E-mini think tank, and I would love to have you join me there. If you're interested, you can go ahead and use the link that was provided in the chat. I want to thank everybody for being here and spending some time with me. And if you have any questions regarding anything I went over, again, email us at support@wealthbuildershq.com. So until next time, everyone, trade safe, trade well, and take care. Thanks for being here, everyone.